Hi everyone, and welcome back to the Independent Dollar. Today we're discussing the different types of mortgage rates, whether a fixed rate or a variable rate term is better right now, and we're also going to be sharing some tips on how you can get the best rate possible and some perks with your new mortgage. For fixed rate mortgages, the main benefit is peace of mind. You get a specific rate that is locked in for your entire term. It will not change regardless of whether or not interest rates jump up or go down. With a variable rate mortgage, the interest rate goes up and down as your bank's prime rate moves up and down. If rates were to go up, then your variable rate mortgage will also go up, usually in increments of 0.25% or less. The main benefits of a variable rate mortgage is that they're usually priced lower than fixed rates, and if rates go down, then your mortgage rate will go down as well. One common misunderstanding with variable rate mortgages is that if rates were to rise, then so does your mortgage payment. What actually happens though is that the total amount of interest in your payment and the amount of money going towards paying down your mortgage balance changes, but your total payment amount remains the same. As rates rise, the interest amount increases while the principal amount decreases. If this were to happen, it would mean that you would end up paying down less of your mortgage during that term. To make up for this, your mortgage payment will likely be higher when you renew. So in today's market with both rates being so low, which rate is better then? When comparing variable and fixed rate mortgages, this is how I like to look at it. Let's say I want a 5-year term and the current fixed rate is 3% and the variable rate is 2.4. If I go with the lower variable rate option, then as long as my interest rate stays below 3% for most of the term, I'll come out ahead. In fact, I'm okay with interest rates rising a few times during my 5-year term, as long as it doesn't go past 3% too early on. In this case, the bank would have to raise my interest rate 3 times or more before it would actually go above 3%. Remember, they usually only increase their base rate by 0.25% or less. According to the Bank of Canada, this is the history of the bank's prime rates over the past 10 years as they moved up and down. Between 2011 and 2015, the rates remained unchanged until they decreased once in 2015 by 0.15%. Between 2016 and 2020, the rates increased 5 times by a total of 1.25% until they sharply declined in 2020 by 1.5%. The bank prime rates tend to follow the overnight rates made by the Bank of Canada. So if you believe that interest rates and the economy are likely to remain flat or maybe even go down, then a variable rate mortgage is ideal. If, however, the economy is set to rebound or the spread between the variable and fixed rate is minimal, then a fixed rate mortgage is likely preferred. As we mentioned earlier, we have a few tips you can use when trying to negotiate your mortgage to either get a better rate or get some extra perks. The banking world is extremely competitive and banks are always trying to get your business to increase what they refer to as their share of wallet, meaning they always want to increase the amount of products you have with them. While you might think this might only apply to those with large bank account balances or investments, banks love to win business that they refer to as anchoring products, which are things like your mortgage or your main checking account that your paycheck goes into and bill payments come out of. So here are a few things that you can offer to negotiate a lower rate. Offer to move over your investments from another bank or brokerage. Offer to open up a bank account and switch over your direct deposit from your employer. Sign up for their credit card or transfer over your line of credit or your loan. If you do most of your banking with them already and you don't have any business to transfer over, then don't be afraid to ask for a few perks like these if you're going to give them your mortgage business. Waiving the cost of your bank account for a year, covering the annual fee for 1 year on your credit card, covering the cost of your checks, safety deposit box, or overdraft for the year, or covering the cost of the appraisal fees on the home that you're buying. All of these are reasonable asks in exchange for your mortgage business.